Hello, I'm Brian Overby, and welcome to Options Guy TV. All right, so we talked last week about a lot of different credit spread trades that we could put on. We actually even looked at a Walmart trade ahead of earnings that where we adjusted a short call spread, and it really turned out to be a skip strike butterfly. But we took it from the approach that, hey, we were thinking about selling the short call spread. How can we do something to adjust the trade? Because bottom line is we didn't really like that short call spread and the credit that was received. So we turned it into an interesting skip strike butterfly, and we just took it from the approach that we wanted to do a short call spread and lean into the market a little bit and actually adjust that trade before the adjustment, right? Adjust the short call spread before the trade even went off. So interesting week last week that went all around short call spreads. We also went out and looked at a short put spread in the USO, and I didn't get a chance to address it on Friday's show. So Options Guy TV is all about, let's set up some paper trades. Let's talk about these trades in real time, and then let's look for an adjustment on these trades. So USO, I want to just highlight that before I get into today's show. So let's run to the chart in the USO and look at where we're at. We're really dancing around the 20-day moving average. We have the 50-day and the 200-day. If I go out, let's go out even a little bit more, just so I get a little bit more data on that 200-day moving average. We see that we had a golden cross. But we're still hanging out right in this range. And if you look at oil today, it was up on the open. The actual crude futures contract was up on the open, and now it's trading kind of flat. USO is up, it looks like about 11 cents on the day. So we're still just kind of hanging here. And on our USO trade that we put on, we're going out until September with that trade, but we just want the market to stay above 72. And we're not there yet. So if right now we're at 72.91. We're almost a full point above the short strike of our short put spread. We use that short put spread to buy a long call option. We're going to stay the course. If it comes down to 72, we're going to think about something that we might do to that trade. So we're going to keep an eye on it because it's a little bit longer term trade. And then also last week, we went back and looked at the adjustment on Charles Schwab on Friday's show. So on Charles Schwab, that's a much longer trade, trying to get long some of the financials. But one of the things that is concerning to me in the marketplace, and let me run back over to my watch list that I have here. So let me get up my markets watch list, is the 10-year. The 10-year yield is above 4.3%. Now, TNX is an index that is put out by the Chicago Board Option Exchange that tracks the yield on the 10-year. So we broke above to a new level, and obviously 4.3 was a range that the 10-year was having a tough time breaking through the upside. So that's a little bit concerning for the financials and also a little bit concerning for the markets. And we've talked a little bit about this, that's the fact that yields are continuing to crawl higher. We have the Fed and Jackson Hole coming up here. And then also in September, we're going to have a Fed meeting. And everything's going to be discussed on, are we going to go up another quarter of a point? Are we going to take a time out? And so everybody's a little nervous about the Jackson Hole meeting, and the VIX is showing it. And so we're going to do something interesting in the VIX. We're a little nervous about what's going on with yields driving and that's probably what's really caused a lot of the downturn in the market. That was started by August 1st and the downgrade of the U.S. debt by a rating agency. And so far, August has just been a tough market for traders. Let's hope that we can get an update today. We see that the NASDAQ right now is up a little less than 1%, pointing to it on my screen. We got the Dow down a little bit. So NASDAQ is up and the Russell is down a little bit. And so let's just call it the markets are even. A little bit of strength in the NASDAQ so far today. All right. So let's jump into it, mainly because we have a very interesting underlying, and I foreshadowed this on Friday's call. We have a very interesting underlying that we want to trade, and it's called the VIX, the volatility index. Now, I was on the Chicago Board Option Exchange Retail Markets Committee. I don't remember what the acronym was that they actually used for that. But when they were thinking about introducing the VIX products, and I have to admit, I did not think that these products could take off. I thought they were way too confusing, and that the retail customer that who I was representing just wouldn't get it, just couldn't understand the fact that the VIX options aren't going to trade off of the spot value or the actual number that is printed when you type in VIX. So when I do this, so when I look at the VIX and I try to put I don't know, a spin to it to try to understand exactly why the VIX is what it is. Everybody knows, and this is very true, and I can almost say this with 100% certainty, even though in the brokerage space, you're really, or when you're a Series 7 broker, you're never supposed to say that there's a guarantee. But if the market goes up in the VIX, if the VIX index spikes, it's a mean reverting index. It's going to come down. It's not like a stock like NVDA, who's going to be announcing earnings here on Wednesday. And we're going to talk a little bit about that stock today. But it's not like a stock like, oh, we came out with this wonderful new chip, and so the stock just continues to go on up, and who knows where it's going to stop. Volatility is like a commodity. But my best analogy that I've ever used about the VIX is like it's like trying to trade options on the weather forecast. The fact that in sunny Charlotte, North Carolina today, it's going to be 95 degrees doesn't mean that a month from now, it's still going to be around 95 degrees, right? You trying to guess where the weather is going to be a month from now is a very hard task. There's a lot of, as you've known, if you watch your local news, a lot of the forecasts on the weather, they have a tough time trying to guess where the temperature and if the likeliness of rain and all that stuff by the end of the week. So going out a month in time is really hard to try to figure. And that's really what you're trying to do when you're looking at the VIX index. And so I like to say that it's like trying to trade options on a weather futures contract. So hence, we go into the VIX index and realize that the VIX does not trade on what the actual index is. There's a futures product that is trying to guess out in time where volatility is going to be. And a huge spike up today because of a big downturn in the markets might adjust the volatility and your numbers going out in the future. But what happens today, like I said, the weather being 95 degrees here in Charlotte, North Carolina, does not necessarily imply what the weather is going to be in September. It might affect it a little bit, but obviously it's not a huge determinant as to what's going to be the weather 23 days from now. I think I beat that up a little bit. But I'm hoping you're kind of getting my gist. If you have any questions about any of these topics on the show, and this is a tough one today, this is probably the most advanced options guy so far, in that the underlying product that we're going to try to set up a trade on is the reason why, or the underlying product that you're going to try to set up the trade on is probably the most complex product that we've had so far. All right. So I am showing, let's go back to my TradeHawk software, and I am showing, we're going to go out to September 13th, 23 days away. That's why I kept using that month out in time analogy. And we're going to try to set up a trade that will take advantage if volatility goes higher going into September. And with that said, let me jump back out, zoom back in here, and I'm going to show you a chart that we talked about on August 15th. So 1 second here. Let's do a little bit of an adjustment, and I'm going to show you this chart. Let me get it up, and I'm going to show you this chart. Now, I got to give credit where credit's due. I saw this little blip on Yahoo talking about what VIX seasonality is for the marketplace. And if you want to pop to and show that chart right now, we see this was a chart. In the one downside of grabbing it from an outside source like Yahoo Finance, which we highlight down here, is they actually didn't really say how many years this represents. I'm guessing 20 years or so of seasonality all mixed into one chart. This was actually August 1st. And I find it so interesting because that's the day that Finch came out and downgraded the US debt. And we had all the trials and tribulations of the marketplace started for August. And also the 10-year yield started going up, started hurting the financials. And yeah, here we are. So this on this chart was August 1st. And I think we did a show either on, I think it was August 4th is when we brought up this chart and talked about it. But it just highlights that a lot of times in the VIX index, we hit the doldrums in the middle of the summer in July. Then we start creeping up in August and September, and even more volatility in October as far as the VIX is concerned. Now, realize this doesn't mean that volatility just stays high throughout the entire month, but it does show you that there's more downturns and more troubles that seem to occur in September and October, and also all the way back here in March too. We still get some volatility in the marketplace, and it gives, I just find this a real interesting chart, so I brought that up. So we're going to trade off of this chart. We're going to set up a trade that's going to put us somewhere in September and say that volatility is going to be higher than it is right now. So how do we do that? And I'm also going to look at an adjustment on this trade. But to start with, I'm going to keep that theme of short spreads, and we're going to look at that in the VIX index. But before we do that, we need to determine in that September contract, where's the future trading? Okay, so it's not really that easy to determine by just looking at the chains. So I'm going to go back to the TradeHawk software, and I'm going to show you what I mean. All right. Once again, if you have questions, please feel free to ask. Now, here's the September 13th contract. We see the VIX at 1783. So I'm going to go pretty close to where that VIX is at. And I'm going to show you that on this date, because there's a Fed meeting that's going to be coming in right around that time. We'll see that the VIX index in the futures contract is actually a little higher than where the market is at right now. So if we look at the 18 strike line for that September 23-day out option contract, we need to create a synthetic stock. Now, if you have futures quotes and you have ability to do that, you can go out and get a futures quote from your futures account. You could also go on to the Chicago Board Option Exchange website and pull up quotes. They're usually delayed on the VIX and the VIX futures, and they'll give you that. I'm not going to go down that road because I want to explain this concept. All right. So synthetically, if you're going to get long stock, a little frog in my throat, excuse me. If you're going to get long stock, what you do is you buy a call, which gives you unlimited upside, and you sell a put with the same strike that helps pay for the call, but makes you have risk to the downside because you can put the stock anywhere below the strike. And if you do it right at the strike price, the same call and the same put, you're synthetically creating stock. So I did that. So I went out and I bought let me grab a little drink of water instead of struggling with this. Okay, we're going to leave that right at 40. Okay. And I bought the 18 strike call, and I sold the 18 strike put. Now, one thing that I want to note here is that if I look just on the ask, the call is trading for more than the put. Now, why is that important? We know the stock is not at 17.99. It's not right at 18. Because, this is actually a great example. It moved up to 18 on the VIX. So this is a great example in that if this was the case, the call and the put should be trading for almost the same amount, right? But the call is quite a bit more expensive than the put. Hint that the futures contract isn't right at 18 where the VIX is at. That was really nice of the VIX to come right up to the 18 strike. And so we're showing you that. So if I do the what if, which I grab this and I put this in our what if calculator, which shows us at expiration what a combination would be. So let's look at that. And we see that synthetically, this looks like long stock. And since we don't know where the future's at, let's create that long stock and see what it's telling us about that futures contract. And so I'm going to jump right back to trading real quick. We see that the midpoint now is 44 cents. So the call is in the money and the put is out of the money. So guess what? We have to take the debit and add it to the strike. The future should be trading for somewhere around 18.44. So it's higher than where the market is at right now, which is 1802 on the, and in the market, I mean, if we're talking futures markets, we would call that the spot, where the spot index is at. So the VIX in September is trading higher, probably because of the potential Fed meeting, than the actual VIX index is right now. Goes along with the chart that we just looked at. Just interesting. Okay. According to our chart and the seasonality, nothing's ever guaranteed, but it's showing that normally, or in past years, the VIX usually goes higher going into September and October. Now, past performance is never a guarantee of future results, but we're going to try to say, well, let's see if this will happen again. So what am I going to do? I'm going to sell a put spread, and I might use those proceeds to buy a long call. Long call, remember, means that we think the markets could go down, because don't forget, the VIX is the fear index, and it's based off of the S&P 500 index options. So the more people that are buying protection drives up the price of these put options in the S&P 500 index, and ultimately that drives up the VIX options. So based off of that information that we have, we know that if the markets go down, the VIX has a tendency to go up. That means that buying calls is saying that you're thinking the market is going the opposite direction. Selling a put spread means that you think the markets in general are going to be more volatile and go the opposite direction. Now, the one thing that's wonderful about the VIX is it just takes one day. It just takes one day of big volatility, and that gives you an opportunity on your trade to try to get out of that trade at a certain level. Now, big move up today doesn't necessarily mean a huge move in the September option contracts, and that's what I'm trying to beat home today. But we're going to do a fun trade in that we're going to sell the 17 strike put, and we're going to buy the 15 strike put. Now, well, let me clear this out. And we're going to do this because this is a very novice trade. If you were ever thinking, like on Options Guy TV, we never think of anything that we do as a recommendation. We always say that they're paper trades because we don't know your account. We don't know your trading. But if you wanted to get your feet wet, I want to have managed risk, and I want to understand how this pricing works. And I want to put on a trade that I can watch, but I don't want to spend a lot of money on it. So we're going to sell the 17 strike put, and we're going to buy protection not that far away. We're going to buy the 15 strike put. We're going to get this done for 68 cents. Now, remember, the market's at 1844. It's not at 1789. It's somewhere around that range. The market looks like it's moving all over the place here on the VIX. We got the SPX, it's still flat. Okay. And so if we do this, the midpoint is a net credit of 68 cents. So that's some decent premium for a 2-point wide trade that we're looking at. So 2 minus 0.68 means our total risk is a 132 or $132. And we're just saying that we think that marketplace could go up. We're neutral to bullish on the VIX. We want the market to stay above 17. Time decay is going to be a big thing. It's going to take a little bit to wither away as far as the VIX is concerned. But if we look at that, the 17 and buying the 15, we are hoping that the VIX stays above 17 by that September 13th date, which is around where the Fed meeting is going to be. I should actually look exactly when the Fed meeting is. It's somewhere right around that time. All right. So that's simple. Now, we're going to keep this trade around. And if we get an opportunity, we may take this credit and go out and buy some calls. Why not do something fun with this trade? It is a paper trade. If I was doing it in my own portfolio, I would just be selling that put. But Options Guy TV is learning about different tricks of the trade and different things that you might do. We looked at this trade in the USO, and the USO is down a little bit in oil in general, where we actually sold a put to try to buy a long call. So we'll consider that. The 23 strike is quite a bit higher. It's not quite trading where I'm at. If we got a little bit of a spike up in this September volatility, well, maybe, or a little bit of a drop down, in this September volatility, maybe we take that net credit and we can maybe buy the 22 strike. If we can get it somewhere close to that 68 cents, I might just do that. All right. Just to try to make it fun, make it more interesting. Okay. So now if we look at the what if scenario, and let's put this back up. And once again, if you have any questions, please feel free to put them in the comment section and we'll try to address them at the end of the show. So I thought I sent that over there. Okay. What if, let's put it in and now I'll show you the difference. Okay. So now the market, remember, is somewhere up here. It's seeing 1791. The market's really right around here. Here's our risk. We're selling a put spread. That means we want the market to stay above our short put. Our short put is our risk in this trade. We're buying protection down around 15. So we're selling this put right at 17, buying protection right around 15, and we're just going to let that trade play out. Now, this is one of those trades where it's really hard to adjust it because it's going to be all over the place. I kind of want to put the trade on. I would like to maybe use those credits if I can get some of the credit to pay for a long call. I might do that, but this isn't a trade that I'm really looking to adjust. I'm going to put the trade on. I'm going to manage the risk. If I can't afford to lose the $1.32 on my 1-by-1 spread or $132 plus commission on this trade, well, then I'm not going to do the trade. Right. It's just the VIX is what it is. It's just all over the place. And you're trading volatility and you're trading the volatility in the options on the volatility index. So that there's a lot going on in this. And if the markets go down, there's a good chance that it could come right back up and roaring right back up before you know it. So that's where we're at. All right. So if we have any questions, please put them in the chat box. And let's see, nothing yet. And I guess we'll go and we'll address that trade. Now, on Wednesday's show, we do have NVDA. Well, it's actually really should kind of address this as far as earnings are concerned. It's the retail theme is still going. We have Lowe's that's going to announce earnings. They'll be on Tuesday. We have Dick's Sporting Goods announcing earnings. And a couple others. Petco is going to be in there. Kohl's is going to be in there, all announcing earnings this week. So the earnings season is still, especially in the retail space, it's still in flux. We're still getting some good numbers. But the Magnificent Seven, the leader of them all, is going to be announcing earnings after the close on Wednesday, and that's NVIDIA. So when we come back on Wednesday, we'll look at a trade in NVIDIA. Total guess as to what direction it's going to go. We've had a big run up. And if we look at NVIDIA, let me grab my default watch list. And 1 second, NVIDIA. And there it is. I knew I had it in there somewhere. NVIDIA is up 4% already today. So a huge move. Let's actually look at let's look at the NVDA. Let's look at the at the money straddle for the nearest term expiration here. Okay. So 4 days away, the August 25th. Oh, wow. So we're looking at about 50 points. The stock is at 51.50. So we're not right at the money. But if we look at here, we got the, let's just go ask. We'll take the ask on the call side and the bid on the put side and add them together. To me, that is my quick and dirty way of figuring out where the midpoint would be, right? So I take the bid, the worst case scenario on the put, and or the best case scenario if you were trying to buy it, and I take the ask, the worst case scenario of trying to buy the call, and I just add them together because it's not an exact science by any means. So 25.10 on the ask of the call, and 25, we'll call it 15. 25.15, we're looking at 52.50 divided by where the market is at, 452. There we go. We'll call it that. So we're looking at 11% move potential in NVIDIA. Man, I could see it doing a little more than that. So we're going to keep that in mind. It'll be an interesting trade. We'll come up with a trade to look at in NVIDIA. A lot of people have this in their portfolios. We can talk about some way that you could protect it, looking at a collar type situation where if you have 100 shares, we'll look at how can we protect ourselves going into this earnings report. And then we'll also look at a fund trade that we have centered around it. We'll try to come up with something creative because there's going to be so much volatility. Now, I do wish that NVIDIA was announcing on a Thursday as opposed to a Wednesday, only because if we do that fund trade or that paper trade that's totally speculative, I would like to have the option contracts only live one day. But I can't choose when they announce earnings. I can put in a request, but I don't think NVIDIA is going to listen to me. All right, I see a trade. All right. Or a question. What do I mean a trade? I see a lot of trades. I'm looking at NVIDIA. But if you create a synthetic stock by selling a put and buying a call at the same strike, would you consider selling a call and buying a put to create a collar position? Yes. And I think I kind of answered that question. Yeah, that would be a collar. So not when you sell a call and sell a put at the same strike, that's very important to say that becomes synthetic stock. But the most common way to do this, and most people would, not a lot of people, I mean, there could be some advantages to doing it that way, but not a lot of people go out and try to create synthetic stock when they could just go buy the stock, not have to deal with the option contracts, not have to deal with bid-ask spreads and all that thing. But the more common thing to do is to do what's called a collar. What I described, I would call a combo, a combination. What I just talked about in NVIDIA would be a collar. You're going to say, I own 100 shares of stock. Now I'm going to go out of the money and buy a put, and I'm going to go out of the money and sell a call. I'm going to say in between those strikes, between the call strike and the put strike, I'm going to play. I'm going to be in the game. But if the market goes way down, I'm going to take my ball and go home. I'm not going to play anymore. Why? Because I own a put. I have the right to sell the stock at that strike. But then I'm also giving up some opportunity on the upside. The market skyrockets after earnings. Well, guess what? I'm not getting any more upside because I'm going to get pegged on that call option. So that's a collar. We talked about a combo. And yeah, there you go. So that was a good, thank you for that question. Any other questions? No, we're right at time once again. I'm excited about the VIX trade. I had it in my head ever since I saw the chart that came out on Yahoo going into September and October. I like to think about the VIX index. It's just so hard to address it because it's such a complex, convoluted underlying to trade on. And when I was at the CBOE Retail Markets Committee, I was wrong. That's simple. I wasn't wrong about the minis. We did say I didn't think the minis would take off, but I was wrong about the VIX. The VIX has been a fairly good product for the CBOE. That's it for this edition of Options Guy TV. Please click subscribe, ring the bell, and and hit that thumbs up. That always helps us here. And let people know about it. Please tweet it out or X it out or whatever you want to call it nowadays and let people know. My name is Brian Overby. I'm known as the Options Guy, and we'll see you this Wednesday for the next edition of Options Guy TV. Thanks for coming, everyone.